There's a number sitting on the IRS website right now, in plain black and white, and most people over 65 in this country have never read it. The number is $6,000 per person, which means if you're married and you both qualify, it's $12,000. And here's the part that should make you sit up. It's not a rumor. It's not a consult a specialist loophole. It's not one of those things you have to be rich to use. It's written into federal law. It's on tax returns being filed this very year. And in about 4 years, it vanishes, gone, expired like it was never there. So let me ask you something, and I want you to actually answer in your head. On your last tax return, the one you filed this spring, did you claim it? Do you even know if you did? Because if you use a bargain piece of software, or you let autopilot through, or you assumed your income was too high or too low, or that someone would tell you, there's a real chance you left money on the table. Not pennies, hundreds of dollars. For some of you, well over 1,000, every single year, for 4 years running. Here's what nobody's telling you. The tax code is not designed to find this money for you. It's designed to why it works, who actually gets it, the one mistake that quietly cancels it, and the 5 moves that let you claim every dollar you're owed before December 31st of this year, and before this window closes for good. Stay with me, because this one's worth real money. Let me tell you who I am, so you know why I'm the one saying this. For more than 20 years, I sat on the other side of the desk as an enrolled agent. That's a tax professional license to represent people directly in front of the IRS. I'm Sam Whitfield, and I'm retired from the daily grind now, but I spent 2 decades watching ordinary people. School teachers, retired nurses, guys who drove a truck for 30 years, overpaid the government for one reason, and one reason only. Nobody walked them to what they were allowed to keep. I've seen a widow hand over 4 figures she never owed. I've seen a couple miss a deduction 3 years in a row because their software was a version behind, and every time the money was right there. They just didn't claim it. Now I have to be straight with you, because that's the only way I know how to do this. This channel is education, a wake-up call. It is not personalized tax, legal, or financial advice. I am not your enrolled agent. I have not seen your return, and I don't know your full picture. So everything I tell you today, you take to your own tax professional and your own financial advisor before you act on it. Think of me as the voice that says, hey, go ask about this. Not the person who files it for you. We clear? Good. Because what I'm about to show you is too important to get half right. And if this is the kind of plain English money talk that actually helps you sleep at night, do me a favor and subscribe. Because this is the stuff they don't teach you, and your bank certainly isn't going to call you about. So let's talk about why this even exists, and how the machine actually works. Because once you see it, you can't unsee it. Here's the mechanism. In retirement, your income doesn't disappear. It changes shape. Social Security comes in, a pension maybe, then the IRA and the 401k start sending you required withdrawals, whether you want them or not. And the cruel little secret of retirement is that a lot of that money is still taxable. You worked, you saved, you did everything right, and the government still has its hand out. Meanwhile, your costs aren't shrinking. They're climbing. Medicare premiums, prescriptions, the dental work insurance won't touch. The long-term care question hanging over everything. This is a health, wealth spiral, and it runs in predictable loop. A health event forces you to pull money out of your accounts. Sometimes a lot of money, fast, and that withdrawal lands on your tax return as income. That income raises your taxable picture, and a higher taxable picture means a bigger tax bill in the exact year you could least afford one. Health pressure becomes a withdrawal. The withdrawal becomes taxable income. The taxable income becomes a tax bill, and the tax bill eats the very savings you're trying to protect, round and round. So Congress, as part of a large tax law passed in the summer of 2025, did something specifically aimed at seniors. They created a brand new deduction, an extra one, on top of what you already get, worth up to $6,000 per person age 65 and older. The whole point of a deduction is simple. It's income the IRS agrees to ignore. It shrinks the slice of your money that gets taxed. And for a lot of folks living on a fixed income, shrinking that slice is the difference between owing the IRS in April and not. Now here's where I need you to really listen, because this is where most channels lie to you to make it sound sexier. $6,000 is a deduction. It is not a $6,000 check showing up in your mailbox. A deduction lowers your taxable income. It doesn't hand you the full amount back. So what's it actually worth in real dollars? Depends on your tax bracket. For a lot of retirees in the 12% bracket, knocking $6,000 off your taxable income saves you about $720 in tax. In the 22% bracket, it's around $1,300. And for a married couple where both spouses are 65 and up, you're stacking two of these. Up to $12,000 off your taxable income, which you mean $1,400 or more in real, kept money. Every year, for 4 years. Run the arithmetic out. And that's potentially $5,000 or more that stays in your pocket over the life of this thing instead of going to Washington. It's not a fortune, but it's not nothing. And it's yours if you claim it. So let's make sure you do. Before the 5 moves, let me tell you about Walter and Diane, because I want you to feel what's at stake here, not just hear numbers. Walter and Diane are a composite, an illustration built from people I actually sat across from. Not one real couple, but every detail is the kind of thing I saw again and again. They're both 68. They live outside Tampa. They've got a modest place, a paid-off car, and one big dream, a 2-week trip to see their daughter and the grandkids out in Arizona, the one they keep putting off because money's always a little tighter than they'd like. Their combined income runs them right around $140,000 in a busy year. Some Social Security, Walter's old pension, and the withdrawals they take from the IRA they spent 30 years building. Now here's what happened. Diane has a knee that finally gave out, and the surgery and the rehab and the things Medicare didn't cover meant they pulled an extra chunk out the IRA late in the year to cover it. Nobody told them to think about the timing. That withdrawal pushed their income up, and the cheap online software they'd used for years, a version behind with none of the new prompts, simply did not flag the new senior deduction in a way they understood. So they took the standard deduction, clicked through and filed, and they missed it, both of them. $12,000 a deduction they were entitled to, gone, because nobody walked them through it and a tax form didn't shout loud enough. In their bracket, that was well over $1,000 of real money, more than the flights to Arizona. The exact trip they keep postponing, paid for, sitting right there on a tax form, and they handed it back to the IRS without ever knowing. Here's what gets me. They didn't do anything reckless. They weren't careless people. They just didn't know what they were allowed to keep, and the system was perfectly happy to let them not know. Don't be Walter. Don't be Diane. Let's make sure that trip gets taken. So here are the 5 moves. Write these down. The first move is to confirm for certain that you actually qualify, because most people get this wrong in both directions. The rule is cleaner than you'd expect. You have to be 65 or older by the last day of the tax year. For the 2025 return, that means you turn 65 on or before December 31st, 2025. And here's a wrinkle the IRS honors. You're considered to reach an age on the day before your birthday. So if your 65th birthday is January 1st, you still count for the prior year. You also need a Social Security number that's valid for employment. That's it on the basics. Now here's what nobody's telling you at the bank. You do not have to be collecting Social Security to get this. I had people swear up and down they weren't eligible because they delayed their benefits. Wrong. Completely wrong. Working seniors qualify. Retired seniors qualify. You do not need to have started your Social Security checks. The only thing that gates you is age, a valid Social Security number, and an income test we'll get to in a second. The action this week is simple. Pull out your most recent tax return, confirm your birthday clears at December 31st line, and stop assuming you don't qualify. Most people who think they don't actually do. The second move is to understand that this thing stacks, and to make sure all the layers actually show up on your return. This is where the real money hides. The $6,000 senior deduction does not replace your standard deduction. It's piled on top. And it doesn't replace the older, smaller extra deduction seniors have always gone for being 65 plus. Either that one's still there too. So picture is 3 layers. Layer 1, the regular standard deduction everybody gets. Layer 2, the long-standing additional standard deduction for being a senior. That's roughly $2,000 for a single filer in 2025, a bit more per spouse for couples. And Layer 3, this new $6,000 deduction. Stack all three, and a single 65-year-old taking the standard deduction can be sheltering well north of $23,000 of income before a dime gets taxed. Here's why it matters for your health and your money both. Every dollar you shelter is a dollar that doesn't force you to pull more out of your accounts to cover the tax, which means more of your nest egg stays invested and available for the medical curveballs that come with age. The proof is right there on the IRS's own eligibility page. This is a fringe reading. The action. When your return is done by you by software or by a preparer, physically look for that new deduction line and confirm it's there. If you're using software, make sure it's the current year's version. A version that a year behind is exactly how Walter and Diane lost their trip. The third move is the one that separates the people who claim every dollar from the people who lose it without ever knowing, and it's all about one number called your MAGI. That stands for Modified Adjusted Gross Income. And for most of you, it's basically your adjusted gross income, the income figure near the bottom of the front page of your tax return. Here's the trap, so listen close. The full $6,000 only holds if your MAGI stays under $75,000 as a single filer or $150,000 as a married couple filing jointly. Go over that line, and the deduction doesn't just stop, it bleeds. It drops by 6 cents for every single dollar you're above the threshold. Let me make that real. Say you're single with a MAGI of $80,000. That's $5,000 over the line. 6 cents on the dollar times 5,000 is $300 gone. So your deduction slips from $6,000 to $5,700. Push up to $130,000 and you're $55,000 over. 6 cents on each of those dollars raises $3,300, and you're left with just $2,700 of your deduction. Climb high enough. For a single filer, that's around $175,000, and it's gone completely. Not a credit you chase. Not a loophole. A deduction that quietly melts as your income rises. And here's the cruel twist that ties right back to that wealth spiral. A big unplanned IRA withdrawal to cover a medical bill, or a poorly timed rock conversion, or a capital gain from selling something. Any of those can shove your MAGI over the line and cost you part or all of this deduction in the exact year you needed relief most. The action, and this one's time sensitive. Before December 31st, get a rough estimate of where your income's going to land for the year. If you're hovering near that threshold, this is a conversation to have with your tax pro right now about whether to delay withdrawal, time a Roth conversion differently, or use a qualified charitable distribution from your IRA to bring that number down. Because December 31st is the door. After it closes, the year is locked. The fourth move is to file the right way, on the right form, so the deduction you qualify for doesn't get lost in the paperwork. 2 pieces here. First, if you're married, you generally have to file jointly to claim this. Couples who file separately typically lose it or get a far worse version of it. So, if you're married and someone's about to file you as married filing separately, stop and ask a professional what that choice actually costs you, because it can be a lot. Second, the IRS added a specific spot for this deduction on return, a new schedule that goes with your 1040. You don't need to become an expert on the form. You need to make sure whoever prepares your return, whether that's good current year software or a human being, actually puts it there. And if you're a couple where both of you are 65 and up, here's your checkpoint. Confirm that the deduction shows up for both of you, not $6,000. 12. I cannot tell you how many joint returns I reviewed where one spouse's portion just wasn't entered. The action. When your return's ready before you sign it, look. Married filing jointly? Check. Deduction present? Check. Both spouses, if both qualify? Check. 3 10-second looks that can be worth $1,000 or more. The fifth move is to treat this like the 4-year window it is, and use every year of it. This deduction is temporary. It runs for tax years 2025, 2026, 2027, and 2028, and then, unless Congress acts to extend it, it expires. That's not a reason to panic. It's a reason to plan. Think about it. For 4 years, you have an extra cushion of deductions sitting under your taxable income. That's a window where certain smart moves get cheaper. For some people. And this is exactly the kind of thing to run past your advisor. These are good years to do Roth conversions, shifting money from a traditional IRA into a Roth, while this deduction helps absorb some of the tax hit, so that down the road your withdrawals come out tax-free and your future required withdrawals shrink. That's the health, wealth spiral working in reverse for once. Using a tax break today to lower the taxable pressure on your savings for the rest of your life. The action. Don't think of this as a one-time thing you do this April and forget. Map all 4 years. Build it into a written plan. And put a recurring note on your calendar for every fall, late October, early November, to check your income before that December 31st door closes, so you never accidentally phase yourself out. That's the framework. Confirm you qualify. Make sure it stacks. Guard your income number. File it right. And use the whole window. 5 moves. Every one of them doable by an ordinary person. So let's turn that into a plain sequence you can actually follow. Because a list you don't act on is just trivia. This week, do one thing. Pull out last year's tax return and look for that new senior deduction. If you can't find it or you're not sure, that's your signal that you may have money to recover. And depending on your situation, an amended return might even be on the table. Ask your tax pro. That's step 1, and it costs you nothing but 10 minutes and a little courage. Then between now and the end of the year, get a rough read on your income. You don't need it to the penny. You need to know, am I comfortably under that threshold or am I dancing near the line? If you're near it, that's your cue to make an appointment with a tax professional before December, not after, to talk timing, withdrawals, conversions, charitable moves. All of those have to happen by December 31st to count for the year. The calendar is the boss here, not you and not me. Then, at filing time this spring, your job is simple verification. Write filing status. Deduction present. Both spouses if it applies. Look before you sign. And then once a year, every fall, you run the same quick check again, because you've got this window through 2028. Slow, steady, written down. No panic moves. No big irreversible decisions made in fear. Just a system. So that when life throws a health scare or a sudden expense at you, your tax strategy is already on paper and your emotions aren't the ones filing your return. That's the whole game in retirement. Build a system while you're calm, so the crisis doesn't get to make your money decisions for you. Now, I know exactly what some of you are thinking right now, because I heard across that desk 1,000 times. You're thinking, if this were real, my advisor would have told me. Or, my tax guy handles all this. I don't need to worry about it. Or the quiet one, this sounds complicated, I'll deal with it later. Let me take those one at a time, gently, but honestly. Your advisor might be terrific, but advisors are busy. Software defaults to the safe path, and brand new deductions are exactly the kind of thing that slips through in a high-volume tax season, especially in the first couple of years of laws in effect, when half the forms are still catching up. The fact that nobody mentioned it doesn't mean it doesn't apply to you. It might just mean it was one more line in a stack of returns. That's not an attack on your preparer. It's a reason to walk in and ask the question directly. Did I get the senior deduction, both of us, for the full amount? A good preparer will respect you for asking, and I'll deal with it later? That's the most expensive sentence in retirement, because here's the brutal truth about how this plays out. Most people watching this will nod along, agree it makes sense, feel good for about an hour, and then do absolutely nothing. The return will get filed the same way it always has. The window will tick down from 4 years to 3 to 2. And the money that was sitting right there, with their name on it, will go to Washington 1 year at a time. Not because they couldn't claim it, because they didn't. Don't be most people. So here's where we are. This deduction exists right now. $6,000 for qualifying person, up to $12,000 for a couple, and it runs through tax year 2028, and then it's gone. Not 5 years, not a decade, for years, and the clock's already running. There are 2 kinds of people from here. There are the people who take 10 minutes, check their return, guard their income before December, and quietly keep every dollar owed for 4 straight years. And they're the people who hesitate, who mean to get to it, who let another filing season autopilot pass them, and who pay for that hesitation and money they'll never see again. Same law, same forms, same $6,000 on the table. The only difference is who reaches out and takes it. So turn off his video. Go find your most recent tax return, right now, today, before the feeling fades, and look for that senior deduction. If it's there, good for you. You're already ahead of most. If it's not there, you can't tell. Write down one note to yourself. Call my tax person and ask about the $6,000 senior deduction. That's it. That's the whole first step. Start today. Because in 6 months, you'll either be glad you checked or you'll be wishing you had, watching another year of it slip away. And do this for me before you go. Drop your filing status in comments, single or married filing jointly. And the word checking, just that, saying it out loud in public, is how people actually follow through. I've watched it work for years. If this opens your eyes even a little, hit that like button so it reaches the next person over 65 who has no idea this money exists, and subscribe so you're here next time, because the next thing you're not telling you is already on its way. And I want you in a room when I break it down. You earned this money over a lifetime. The least the system can do is let you keep a little more of it. Go claim every dollar. I'll see you in the next one.